Hi, everybody. This is Jeff Fowler with the Apartment Owners Association. It's great to have you with us today. Some of you are on YouTube. Some of you are watching from AOAUSA.com. Some of you are in the Zoom. It's great to be in the Zoom because you can raise your hand and we can take your question live, and it's way more engaging. So you can jump in here if you'd like. Today we're talking about unlocking real estate tax secrets, understanding what breaks and risks and red flags that there are. And just super excited about this material and about our speaker today. Our goal is to help you make and keep more money than ever before. So this really lines up with that because I believe she'll have some ideas for you. And we do have some upcoming in-person seminars, and yeah, just to get into those, on Thursday, the 15th in Sherman Oaks, we have a resident manager law update, and that's a like a employment law attorney that's speaking on that. That's not an eviction attorney. So that's one you may want to attend in person. And then how to retire from active real estate. So that's a double header. That's in Sherman Oaks on the 15th, and then on the 20th in San Jose. We have the changes to the rental agreements and eviction notices that we'll be covering, as well as 1031 exchange stuff. And then on the 21st in Alameda, we'll have changes to the San Francisco and Oakland rental agreements. And anyway, so two different seminars, well, 2 different days, and those are double seminars. So hopefully you can make one of those if they're in your area. And then we do have the Bay Area Landlording Power Conference that's coming up March 26th. And so there's a great lineup of speakers, and we'll have vendors there. It's a free event. You just need to register. You do pay for lunch, but we subsidize it pretty good. So you may want to sign up for all of that if you're up in that area. And yeah, there are a lot of new forms that we have, and so we're wanting to cover some of those things, lots of overhauls, and that relates to new laws, and then also just every year trying to continuously improve, trying to get better all the time. And also coming up on January 24th, this is a Saturday. It's the AOA Political Action Committee luncheon at the Torrance Marriott. So get a Marriott lunch, and we'll have LA District Attorney Nathan Hochman speaking, and there'll be a silent auction. And we just have to build the number of people that are engaged with what's going on. And so some of you may know that AB 1157 is looking to cap rents even further on a statewide basis, and so we all need to oppose that. We'll be sending out our mid-month newsletter. I hope you're getting that. We put some work into that and just try to keep you updated. In addition to the magazine that we're sending you, we put that together, and there'll be a communication in there with a link that has an email that you can easily send. We prepare the letter for you basically, and when you put in your zip code, then it knows which assembly members to send that to. So be on the lookout for that tomorrow. And we just want to get as many people activated as possible. So hopefully you can make the pack luncheon. And if you can't make it, at least hopefully you're able to engage with us and participate with us as we try to let our voice be heard. And yeah, we have over 20,000 members in our association, but if only 1% participates in the letter campaign, then, we're just a fraction of what we should be. So hopefully we can all get that done. Next week, we have a live stream, LA City Housing Compliance and Eviction Defense. There'll be an attorney that talks about that. And we just want to thank our sponsor for this specific live stream. It's Robert Hall and Associates. So since 1971, they've been dedicated to providing high quality tax preparation and accounting services to the businesses and residents of Los Angeles. Around 80% of their clients are rental property owners, and it was founded by Robert Hall, who began preparing taxes for fellow teachers out of his garage. And really, the firm's quickly grew, and now it services all of California, not just LA, all of California, and really rental property owners all over the nation. And so really love what they're doing. And even with our property management software, we had them look at our program and they gave us great advice on how to structure our reports, the P&Ls and things like that, so that it would be easy for them to do taxes for you. And if it's easy for them, it's probably easier for maybe who you're currently working with. So our speaker today is federally licensed enrolled agent. And so enrolled agent is different than just a regular CPA. It's higher. And anyway, so super qualified with nearly a decade of experience, specializing in taxes for real estate, um, small businesses, startups, and creators. She holds a master's degree from UC Berkeley, and she's frequently quoted in outlets like the Wall Street Journal. And she's currently serving as an enrolled agent with Robert Hall and Associates. So, Nicole Green, it's great to have you with us today. And I'm going to hand this over to you.
Thank you so
And
much for having me. I'm
thank you.
excited.
Great. Yeah, so I'll go ahead and let you take it from here. And if you want to, I don't know, uh, guys, do we have her presentation? Okay, I think I see
Yep,
it.
we do. Thank
Awesome.
you, everybody, for having me. We're talking about taxes, which I know people not kind of grown and everything, but if you spend a little bit of time in your taxes and your tax world, you can really turn your investments into really big strategies and you can really use your taxes. I always give that example, like it could be as dull as a butter knife or as sharp as a machete. It's your choice of what you want to do. And we're going to talk about some examples and some things that can really, really help. And we're also going to talk about red flags. As previously stated, I do work at Robert Hall and Associates. I love the firm here. We are a tax firm, meaning that that's all we do. We specialize in tax strategies and the world of tax because I just find it to be so much fun. It's always available. If you have any questions or you'd like a discovery call to see what's going on, you can, of course, send me an email. My name is Nicole Green. My email, nicole.green@roberthalltaxes.com, or you can scan the QR code and set up a free discovery call. This is a really great way for people to just get a second opinion about what's going on in their tax world. You know, it's always difficult to get a hold of a doctor, a mechanic, a lawyer, or an accountant. And this is a really good way to be able to speak with us at no cost. I'm not giving any real estate advice. I am federally licensed, as we do work nationally and a little bit internationally as well. Okay, so let's get into the world of tax. When we're talking about real estate can be seen as such a great investment. And sometimes people look at real estate as going to have a ton of deductions and it's going to lower their taxes down to like nothing. And it can, if you're set up in the proper way. If you are deemed a real estate professional, you now are going to be able to take real estate, which is typically seen as passive in the tax world. You can go ahead and see it as active. And when something is active, it goes against other types of income. And so if you have a loss in your real estate portfolio in your tax return. And most times real estate rentals they run at a loss on the tax returns because of depreciation, because of other expenses, etc. And that's totally fine. We don't want it to be a loss in profit for you. We just want it to be a loss on the tax return. And you're having at a loss on your tax return, and you have other income like a W-2 job, maybe a spouse is working or something else, you have another business, whatever. That real estate loss, when it is passive, will not go against that other income because passive losses only go against other types of passive losses. When you're a real estate professional, those passive losses turn to active and those losses can go against other types of income. because all it is checking a box. There is increased IRS scrutiny with this because so many people use it incorrectly. It's very similar to how it was back in the day when, especially like during COVID even, but like even further back in the day when everybody was trying to use business use of home, and people that, were working at like JP Morgan were like, well, I work from home, so I get to use business use of home. And I'm like, is JP Morgan now your business? Like, no, that's not your business. Like, you don't get business use of home. You need to go talk to your employer, not the government, to look for that. And so when people use things incorrectly so frequently, of course, it's going to draw more attention. That doesn't mean don't use real estate professional by any means. If you qualify for real estate professional, absolutely use it. It can be a very big advantage. We just need to make sure you're doing it correctly. Let's talk about how do you qualify as a real estate professional. You need to meet three things. You need to have the material participation, which is really, really easy. It comes out to be about 10 hours a week for material participation, about 750 hours a year. The majority of your earned income needs to come from real estate. And then you need to spend the majority of your working time doing real estate. You need to meet all three factors. If you meet all three factors, you can deem yourself a real estate professional. So like I had a client, and the client worked doing like data coding or whatever, and they had a job where they literally were saying like, Nicole, I promise you, I only work, 10 or so hours a week because they were really efficient, blah, 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 blah. However, their W-2 job where they were only doing it 10 hours a week, they were paid more than the real estate. And so that means they couldn't be real estate professional. You can have active participation, but you couldn't be deemed real estate professional because you have to meet all three parts. The majority of your earned income. We're not talking dividends. We're not talking interest. We're not talking stocks. We're not talking those things. We're talking earned income. The majority of your earned income needs to come from real estate. You need to meet the material participation, which that's very easy to do. And then you need to spend the majority of your working time on real estate that you personally are an owner in. And so if you can meet all three categories, then you can go ahead and deem yourself a real estate professional. Your real estate losses are going to become active. And so your losses can go against other types of things. And that can be a really big benefit. On a side note, you do not need to be real estate professional every year. And so if you have 1 year where you do qualify and you could go ahead and elect to be a real estate professional, but then the next year you don't qualify, that's okay. You can qualify some years and not qualify every year. It doesn't, people change jobs, like that's okay. That's not going to be like a trigger for an audit or anything like that. So when we're talking about being a real estate professional or not being a real estate professional, we're really focusing in on real estate losses. And when you have real estate, that's kind of the fun part about it, is because it is a thing that can produce quite a bit of losses on your tax return, and you can play around with these losses. One way to do that is through a cost segregation study. So when you have real estate, we're going to depreciate the asset, right? So you buy a home, and that home, the expense of the home, you buy it for, $200,000. Obviously, it's not bought in California. And you have $170,000 of usable depreciation. You're going to spread that $170,000 over the next 27 and a half years. That is not something that you get to choose to do or not choose to do. You have to do that because you have to depreciate your asset. However, certain things qualify for bonus depreciation, meaning you can take that full expense, that full depreciation in the first year. If it has a 5, 10, or 7, 5, 10, 7, or 15-year timeline, you can have a bonus depreciation where you can pull the depreciation forward and have it used in the first year. And so if you have a house and you get a cost segregation study, they're going to go through and they're going to say that $200,000 that you spent, well, they're going to go and itemize all of those things. And so they're going to say the windows, that has a 25-year timeline. They're going to say the carpet has a 6-year, the refrigerator has a 5-year, they're going to go through and they're going to itemize all of those things. And so some of those things, a good amount of those things, will be able to have bonus depreciation. And so you can pull this depreciation forward. And so that it's a really great strategy for people that want to increase their portfolio. And now that you have a bunch of depreciation pulled forward, you're going to have a larger loss in your time. And so you're going to have this reduced taxes. And so I want to show an example of what I'm talking about right here. So this person right here they had two rentals. One of the rentals was a new rental and one of the rentals was an old rental. And they had about $33,000 of profit showing here. And that gave them about $20,000 of total tax, right? Amongst their other bits of income. So we have $20,850 of total tax. We had one of the rentals, the new rental, because when you're doing bonus depreciation, it's only going to be applied for things in the first year that it was put into service. So you can't have bonus depreciation on something that you've already been using. It's only going to be in the first year that you put it into service. And so we had them go do a cost segregation on the new rental, and they were able to accelerate about 40-some thousand of depreciation. And so that changed from a $33,000 of profit on the tax return to an $11,500 loss. And so that $11,500 loss took their $20,850 of total tax and it reduced it to $11,600 on just the federal side. This also, depending on your state, can be done on the state side as well, because some states don't conform and some states do conform. Most states, to be fair, do actually conform, especially with a cost segregation study. And this is a fabulous way where you can take your tax savings, not new money, you can take your tax savings and go put it into another rental, go purchase another property. And so this is how you don't have to throw new money to expand their portfolio. Remember, you're pulling your deduction from your future self and you're using it now for today's self. And so yes, we're going to have some issues later on because we've now depreciated all of our properties, but we've expanded your portfolio. You've expanded your portfolio 3-4x's. And so now our income is higher and we're dealing with kind of some fun problems a little bit later in life. And so this is a really great strategy that people can use when they're trying to expand. If you want to use it and go on vacation to Tahiti, not my best suggestion, because you're just taking away a deduction that you have in the future. It's kind of like putting a vacation on a credit card, like, well, if you can't afford it, what are we doing type of situation. But it is a really, really great strategy for people that are trying to expand. Remember that a couple of key things that people need to remember: it has to be new because we need it to be the first year that it's put into service. And then you also need a substantial amount here. We're not going to, cost segregations are not really great for low amounts of depreciation because it costs money to do the cost seg. It costs, and so you want to make sure that your tax savings isn't just being spent on expenses. We want to make sure that the tax savings after the expenses is still significant enough that you can go and invest and you can go and use that tax savings. And so you need to really do it on a pretty significant property. It's great for commercial, it's great for multifamily. It's really, really great for those types of things. Okay, the next thing I want to talk about is audits. Everybody, when you think about your tax returns and how all things happen in the tax world, of course, people get really, really afraid about audits. Audits are just the government going, this doesn't make sense. Let's ask more questions. That's all it is the government trying to ask more questions and trying to get a little bit more information, because whatever you are presenting doesn't make sense and it doesn't show what is considered to be ordinary or necessary. And so let's talk about some really big triggers that really kind of throw up the red flags about why something may not make sense. And then you have to go through the audit process. Really large deductions in comparison to income. If you have a business and you have $10,000 of revenue, that's money before expenses, and then you have $70,000 of expenses, the government is going to say to you, is this actually a business? Is this something? Because if you have $10,000 of revenue and $70,000 of expenses and you're showing a $60,000 loss, is this a business? Like, you're showing a loss. Businesses should not necessarily be running at a complete loss over and over and over again. And so when I talk to some clients that actually can have really large losses in a couple of years, that's totally fine. You just need to make sure you're set up in the proper way. Should you be running really large losses on your personal return? No. You might need to go ahead and incorporate. We might need to go ahead and change the structure so that it sets it up a little bit differently. And I'm going to talk about different ways, different entities that can handle those types of things. We'll talk about those a little bit later. Missing or underreporting income. The government is asking you when you fill out your tax return to give them all of the information, but they already have it. And so if you're already saying like, hey, I didn't do this, they're of course going to be like, well, what else are you hiding? Like, and hiding income is the last thing that people should be doing. Underreporting income is the last thing in the entire world that people should be doing, because you're relying on the person that gave you that income to not report that deduction. Because, and it's a deduction to them, they're totally hurting themselves if they're not reporting that deduction. Because if the government comes around and asks them to justify that deduction, they're immediately going to trace that money and say, like, okay, this person paid you, did you report that payment? And so missing or underreporting income just means that, hello, the government's going like, I already know you're lying. I already know this. Let's go find out what else you're lying about. Credits. A credit is the government covering your tax. That is what the credit is. A deduction reduces your taxable income, but the credit is the government actually covering your tax. Some credits are refundable and some credits are not refundable, meaning that some credits you can actually receive the excess amount to you. And so if you have a $10,000 liability and you have a $12,000 credit, if it is refundable, you will get that remaining $2,000. If it is non-refundable, you don't get that remaining $2,000. If the government has to come out of their own pocket and give you money, they are going to look at you a little bit more in depth. Doesn't mean credits are a bad thing. We just need to make sure you know that you qualify for the said credit. Also, the people that do qualify for a lot of refundable credits are going to be a little bit more on the lower income side, and that's also another part of the reason why they do attach a little bit more scrutiny. This last one here about the red flags drives me absolutely insane. Nothing that you purchase is coming out in round numbers. It really isn't. And so when I'm looking at P&Ls and people are saying 25,000, 38,000, 600, how do you get these round numbers? You don't purchase things like this. This is not how it is. And so that's the government already going like, you didn't do this. You did not give us the incorrect information. You are rounding. You are averaging. You are guessing. They don't want you to guess. They want you to go get the information. And if you're going to guess, they'll say, okay, now we're going to force you to go get the information. Round numbers don't exist. Go get the real information. Like, it never, ever, ever happens. And so when you're seeing that on a P&L, that's how we know already that you're going to attract a little bit more attention. So earlier I was talking about, hey, if you have like lots of losses and things, there's different types of strategies or different types of incorporations that can help you. One of the reasons that we tell people sometimes it's time to incorporate, it's time to move this either into an LLC or an S Corp or a C Corp or whatever it may be, is because you are able to provide the government with more information from the jump. That is just the nature of what the return is. I can't just attach a balance sheet, attach a P&L to a personal return. And so when things are a little bit skewed, I want to give the government a little bit more information so that they can understand that this is legitimate. Because sometimes that, you can have something that's a little bit off, that's not normal, and that's totally fine. Partnerships and S corps have the lowest percentage of audits, while C corps and individual returns have a higher percent of audits. So C corps are going to have a little bit of a higher percent of audits because people try to get away from that double taxation, and they do it usually through officer loans. And that is not, it's not actually a loan to a shareholder. It's actually you taking out money, and it should be seen as you taking a distribution and a dividend, and then you need to get taxed on it. But because C corps can have a little bit of double taxation, people try to like work around it, and the government knows, and so they do a lot of audits on C corps. And so you need to be very careful when you're into a C corp of how long you want to stay a C corp and what that means for the C corp. While personal returns get frequently audited because you have people putting Schedule Cs together and taking really large losses, right? We have like the Uber drivers going like, oh, okay, I'm going to take a $50,000 loss on my personal return. And that's not what we can deem as like an actual type of business. And so personal returns can be a really big type of thing. Remember, there's two types of people that get audited the most: people with lower income, and that's because they also qualify for a lot of credits. They also aren't going to spend a lot of money or don't have the means to spend money on getting professional advice when they're doing their tax returns. And so just naturally they're going to have more errors in their tax return, thus they get audited quite frequently. Credits, errors, quite frequently. And then high income earners, they also are getting audited quite frequently, but that's because they do stuff. That's because they're doing a lot of advanced tax strategies. And that's okay. You just need to know that, hey, if I'm in this type of ground, I need to shore myself up. And when I have clients that are doing some advanced tax strategies, I let them know this is going to be something that will increase, not guarantee, but increase the chances of audit. So we need to do this and this and this and this, so that if we do get audited, we can close that audit with a zero change. Because sometimes people get audited, and that's fine. You hire a professional, they will handle your audit, and you walk away with a zero change audit. And you saved yourself that $100,000 or whatever you did in that advanced strategy. But also, you need to make sure you're doing the advanced strategy and that the savings will make up for it. If you're doing an advanced strategy, if you're doing something to increase the chance of audit, like you're trying to take, a $30,000 loss on a Schedule C, and it saves you $6,000 of tax, greatly increases your chances of an audit. I don't know if that's really going to be worth it when you think about the cost of the audit or the pressure of that audit all the time long. If you're doing an advanced strategy like a fee simple, a DB plan, something, I don't know, whatever we're doing, and it's saving you $100,000 of tax and it's increasing our chances of audit, but the tax savings is worth it. You got to make sure that we're talking about, does the risk meet the rewards that we have going on with things? If that answer is yes, the risk meets the rewards, then that is a wonderful thing and it's perfect. When we're talking about the structures that you have, people always get kind of like mixed up, right? So there's really two types of structures that exist in the world. There's corporations, and then there's different versions of LLCs: sole proprietor, single member LLC, partnerships, general partnerships. There's all different types of versions of LLCs, but they're all LLCs. LLCs are for holdings. Corporations are for doing. LLCs are a great thing to hold assets, while corporations are a great thing when you do things, when you're active and you're doing things. So real estate is perfect inside LLCs. Real estates are not great inside corporations. Real estate, especially S corps where they're passed through, real estate is not where you want it to be inside the S corp. You want to put that in LLC. Yes, you can have multiple LLCs and then have the S corp own the LLCs. That's totally fine. But the actual real estate itself should be inside the LLC. You can have LLCs, or people think sometimes like, oh, it's going to be a great way for deductions and all of that. It's not. It's really for asset protection. That's what it is. Yes, you can have a little bit extra deductions that get counted inside because it's now in an LLC, but think of an LLC as maybe an insurance policy or a different type of insurance policy. And so when people are trying to put their real estate in LLC, it becomes how many properties do you put in a single LLC? Sometimes people are saying like, oh, let's put one property per LLC. Huh? LLCs you need to maintain, right? You need to file a tax
Mhm.
return for the LLC. That's an expense. You need to pay an annual tax to the state. Almost all states have an annual tax for these LLCs. This is an expense. You need to also do the bookkeeping and all of that. And so you need to look to see, does it make sense for me to put a single property inside an LLC? And at the end of the day, I usually recommend no. We usually tell people roughly about three, unless you have a riskier property. I'm not an attorney, and so take all of this with a little bit of a grain of salt. But if you are having a property that you feel has a higher chance of a lawsuit, maybe you have like you're doing college dorms or something like that, maybe that singular property should be in its own LLC, and then you have your 4 single family houses in another LLC. That can make a little bit more sense so that you can separate your assets. If you are feeling that no, all of my properties are pretty low risk, then go ahead and combine them. Remember, your LLC needs to be registered in the state that it holds the asset. And so if we have a property in Florida and we are residents of California, we're not going to have a California LLC hold the Florida real estate. We're going to have a Florida LLC hold the real estate in Florida, and you can still apply and have it while you're a resident of California. That's totally fine. But your LLC should be where the asset is. And so you can have multiple states, but you can also have your LLC be in multiple states. That's totally fine as well. The last thing I want to talk about is the big, beautiful bill. We have a lot of tax changes that have happened with the one big, beautiful bill. So, first and foremost, when I was previously an educator, and so I'm going to give a little bit of education here. When a president comes in to do tax changes, and most presidents do them, they are temporary. And so we knew that whatever president came into office this term, there was going to be some tax changes, because when Trump was in office, his first term, he did the TCJA Act. And the TCJA Act, a lot of those things were expiring. There was he changed the corporate tax rate to 21%, increased the standard deduction. There was a bunch of things that were going to expire in 2025. And so we knew that whatever president was going to come in was going to extend the TCJA Act, let the TCJA Act expire, or create and create their own new thing. And Trump did a combination of that. He extended the things that were happening with the TCJA Act. So meaning that the things that you have been doing for about the last like 6, 7, 8 years, you can continue to do. And he added things as well. One of the things that he added was an increase to the child tax credit. The child tax credit used to be $2,000. It is now $2,200. And it also is going to index with inflation, meaning that it will increase as inflation increases. And so it doesn't need somebody to go in and increase it. It will just continuously increase with inflation. Remember, credits pay directly your tax while deductions reduce your tax liability. So the child tax credit is really, really nice because it pays your tax straight off, which is really nice. The SALT tax deduction has been capped at $10,000. That was something that happened in the TCJA Act, and that is increased to $40,000. SALT taxes are state and local taxes. And so if you itemize, you're looking at medical expenses, SALT taxes, mortgage interest, and charitable deductions. And you're looking at those four things to see if you should be able to itemize. And the $10,000 tax for SALT taxes, state and local taxes, is really, really painful because that means sales tax, property tax, income tax that you pay to the state. You're only going to get a $10,000 deduction from it, or we've previously been getting a $10,000 deduction. Me living in California, my property tax is over $10,000, just that. And so I'm not able to get a full deduction because it's been capped at that 10,000. So it increasing to the 40,000 for tax returns under 500 grand is really nice because it's a way for people to get more deductions on things they're already spending without increasing the spending, right? We don't want people to go out and spend more money for a tax deduction. We want people to look at what they're already spending and see how you can work that in to be deductible. And so now you can have an extra $30,000 of a deduction if your income is under $500,000. And so this is really, really nice. One thing that made really big headlines is no tax on tips and overtime. And it's like, well, kind of. It's not completely no tax on tips and overtime. So first, it's going to be for people that are making under $150,000. And if you make under $150,000, you can have no federal tax on $25,000 of overtime. This can be for one person or it can be for two people, but it caps at $25,000 of federal tax. And for the tips, excuse me. For overtime, it's going to be $12,500 per person. And so for overtime, you can only have $12,500 per person, while tips, it could be $25,000 for one person. And it just essentially means the tax return needs to be maxing out at $25,000. And it's going to be federal tax. It is not state tax, and it is not payroll taxes. You do pay payroll taxes and state taxes on tip and overtime. And you can see now on your W-2, there is other boxes, and box 14, there's other spots now where they're indicating the overtime and they're indicating the amount of tips that you have as well. Then another thing that made really big headlines was no tax on Social Security. And this is true for some people. And people need to really understand how Social Security is taxed as a whole. Social Security is taxed in three different categories. We're at 0%, you're at 50%, or you're at 85% of your Social Security being taxed. To figure out which of those three brackets you fall into, you need to add up your other bit of income that you have coming in, whether you have dividends, capital gains, whatever it is, add up all of your other income and half of your Social Security. If you are a single filer and you're under 24,000 of your other income and half of your Social Security, then none of your Social Security will be taxed. If you're at 24,000, between 24,000 and 34,000 as a single filer, then half of your Social Security will be taxed. If you're over the $34,000, then 85% of your Social Security will be taxed. Never in any situation is 100% of people's Social Security taxed, and a lot of states like California does not tax Social Security. And so what the one big beautiful bill has done is they have given each person that takes Social Security a $6,000 deduction. And so if you're remembering, I said that there was about a $9,999 difference between the two brackets, between that 50% and that 0%. And so what that has done, because they have this $6,000 deduction, it has moved a lot of the people that were in that 50% bracket, and it has dropped them down to that 0% bracket. And it's taken some people in the 85% bracket and it has dropped them down to some to the 50% bracket, not a ton. And so that has made several people reduce their Social Security tax, or it has made a lot of people go for zero, go from 50 to zero. And so they have no tax on Social Security. Your income needs to be 70, your AGI needs to be $75,000 or less, or 150 if you're a joint filer. So remember that it doesn't apply to everybody. Not everybody is getting this $6,000 deduction. It's only going to be for people that meet the income limits. But it is quite a few people that are receiving Social Security. Another really big thing that has happened is when we're talking about itemizers, people that itemize, you can now include auto loan interest in your itemization calculations. And so normally we can just look at our mortgage interest on our primary home. And so like if you have a home, remember it's only $750,000 worth of your mortgage. And meaning if I have a home and my mortgage is less than 750, I can take all of my mortgage interest. If I have $1 million mortgage and my mortgage interest is 10,000, then I can only take 7,500, right? Because it's only worth 75,000 of your mortgage. But you can now include auto loan interest inside of that. And so if you have a car that was assembled in the United States, you could have previously purchased it or you could have purchased it this year, it doesn't matter. And the loan is in your name and you are paying the interest on this loan. You can now deduct, included in your mortgage interest, you can deduct up to $10,000. This does phase out for single filers if your AGI is 100,000 and married filing joint filers if your AGI is 200,000. But again, it's something that you're already spending that you can include a deduction in. We don't want you to go out, find more deductions. We want you and spend more money. We want you to look at what you're already spending and see how you can include it. And this is a way for people to get more deductions. It's really nice. We have the gift tax exemption. It has been raised up to 15 million. This gift tax exemption has generally increased year over year, but it's a nice for your lifetime exemption. We also have a charitable deduction for non-itemizers. When like during COVID, we had this as well. You like during COVID, if you took the standard deduction and you gave to a charity, you were able to take an additional $300 of a deduction. And now with the one big beautiful bill, you can take $1,000 for single filers and $2,000. Normally, when you take this standard deduction, you don't look at charitable contributions because you're taking the standard. We've already added up your itemized stuff. And now this essentially kind of increases everybody's standard deduction by $1,000 because I'm sure that you've given money to a charity, to church, temple, or whatever, or like a GoFundMe or something or another. And so now you can count that cash donation even though you're taking the standard deduction. We also have the Trump accounts or baby bonds. Now, these are really cool, and this is to help fight people's fears about Social Security. Social Security might not be around, and so this is going to help that. What it is for children that were born in 2025 to 2028. They will receive $1,000 if their families go and open these accounts. They will receive $1,000. These accounts are basically traditional IRAs. They receive this $1,000. You hope it grows and grows and grows. And then when you become retirement age, they now have an additional retirement account. Remember, it's treated as a traditional IRA, and so it is pre-tax. So when they pull the money out of it, they will be taxed on the money that is pulled out. But you just had all of this growth off this $1,000. Other people can contribute to the account. You can do up to $5,000 a year. And so this is really nice that if you have friends or if you have, grandkids, or, just that you want to give money to these children, but you don't, like, how do you give money to like your friend's kid? Like, do I give it to the parents, and the parents are, what are you going to do? Are you going to go buy toys with it? Or, I can now contribute to the Trump account, or the baby bonds, if people prefer that name, which I obviously do. Um, and so now you can give money to the kids in themselves, and it is going to sit there, and it actually is going to grow for the kids' future. Remember that retirement accounts, the whole point is you want them to sit for quite a long time. However, if the child does need the money after they are 18, there is ways to pull that money out. So you can use some of that money for their first home purchase. They can use it for school. They can use it for medical expenses. There is ways, but it is difficult. And there are penalties that happen if you do not use it correctly. And so we highly, highly recommend that people don't use their retirement accounts to fund their lives. But in emergencies, there are ways that you can pull that money out temporarily, without getting penalties. Um, for that. But this is a really nice thing. The accounts are going to apply for kids that were born in 2025 all the way up to 2028. But the accounts have not been opened, and they will not start to get opened until later in this year of 2026. I believe they said third quarter of 2026. And then families will go in and make these accounts. And once the kid is 18, they can go ahead and transfer the accounts. They can roll the accounts over, and they can go ahead and, do whatever. Like, it's just like basically like they have a traditional IRA. When I was a child, I earned some money, and my parents had me put that money into a Roth IRA account. And I promised that no more than $15,000 over a couple of years was put into that Roth IRA account. And currently that account sits at over six figures. We put in no more than $15,000, and currently it's sitting at six figures because of compound interest, because it sits there for such a long time. So people think, oh, $1,000 really isn't that much. But if that $1,000 is sitting there for 50 years, it could be quite a big benefit for these kids. And so this is a nice thing, and it's a free $1,000. Energy credits, those have completely ended almost for the electric vehicles. For solar and wind credits, you can still get those, but they will be phasing out mid 2026. Remember, we all saw like Trump and Elon having a big public fight, rumored to this being part of the reason for that. And so if you have purchased a vehicle before September of 2025, you can still have your energy credit. But if you purchase a electric vehicle after September of 2025, there will be no credits, not even giving the credit to the dealer. Like, there is just no more electric vehicle credits. But clean air, like wind and solar, if you're thinking about getting that credit, you can go ahead and do that. And that's the big credit, is the wind and the solar credit, because those credits are, you can carry them forward. And so like with the EV credits, if you didn't use it, you lost it in the year that you purchased the EV. But the solar credit is also a larger credit. It's 30% of the cost of the solar or the wind. And if you don't use all of that credit, you can use it in the next year. It carries forward, which is really, really nice. And so if you were thinking about getting solar and purchasing solar, this is the time to do it, because this credit is going to end mid 2026. And on a little bit of a side note here, obviously, um renewable energy is becoming a really big business and is like it's billion-dollar industry, and there's people that are making quite a bit of money off of it. There's people that have created these big solar fields, and they're getting revenue from selling the energy, da da da. But they also, when they did this, they also got credits, and people sold these credits to other people. And so you can go out and buy other people's credits. And so you usually buy them at anywhere from like a 10%, like 5 to 10% discount. And so you can go buy a $10,000 credit from somebody for like $9,000. And so now you just saved yourself $1,000 that you would have had to give into the government. And so, because these credits are going to start expiring in the next few years, you're going to see people selling these credits at a much bigger discount because they're going to need to get rid of the credits that they got. So, that's just a little side note for people. There's a lot of other little things that you can see with the one big beautiful bill, but of course, we only have so much time. If you have some more questions, please feel free to scan the QR code or send us an email. We'd be happy to see how all of these things apply to you. But I do want to take some time right now to like open it up for questions to see if people have questions.
Great. Yeah. So right now, if you're on Zoom in the Zoom meeting, go ahead and raise your hand, and you can do that at the bottom. There's a little, you'll see a little icon there where if you hit that, you'll raise your hand, and then I will ask you to unmute yourself and go ahead and give us the question verbally. I do see questions just on the chat. Andrew, yeah, let's go ahead and unmute yourself and go ahead and ask your question. And you can put on your video if you'd like, or if you still have bedhead, that's okay, you know.
Hi, thank you so much. It was a great presentation. I was asking about the big beautiful bill bonus depreciation. I recently converted a garage to an ADU, so the building had been placed in service, 10 years ago, but the ADU got placed into service this year or just recently. Does that count for the bonus depreciation, or do I need to do a cost segregation because I already have all the expenses on that?
So for the ADU itself, you can do a cost segregation study on the ADU to go ahead and get it. Yes, it would count for the bonus depreciation because the ADU is being put into service now. And so that's when the depreciation for the ADU starts because that's separate than the rental in itself.
Cool, thank you.
Great, thanks, Andrew. And then you could just lower your hand, and anybody else, it's super engaging to do it like that. Thank you. And yeah, if you lower your hand, thank you. And mute yourself back just in case, kids are running around or whatever. Nicole, can anybody do a cost segregation? How's that performed?
Yeah, you just go get a licensed person. So what I always recommend is any type of person that any company that does cost segs, they will give you a free estimate of what the cost. Take that estimate, go speak to your tax professional so you can see how it actually applies. And then before you pay the money for the cost seg, you can see really in your situation exactly how much you're going to be saving and if it is worth it or not, because you are pulling your expenses, your deductions in the future, you're pulling them forward.
Great. And that's actually a pretty technical report, is it not?
Yes.
And
Yes.
yeah,
That's
great.
why you have to get a licensed professional to go out and do it. Yeah.
Exactly. So, okay, we got Andrew answered there. Anyone else have? I can just go off of these in the chat here, and just raise your hand if you have a question and you're on Zoom. For Don, he says his question is: spouse has a W-2 income. Does it count toward earned income for purpose of real estate professional qualifying in California?
So real estate professional is going to be for the single person, right? And so if I'm a real estate professional, I'm only looking at my earned income to see if I qualify. It's not going to count for your spouse. You're just looking at your personal income. And so that's one really nice thing is you can have one person be a real estate professional and then you have another person that has like the W-2, and so the losses can go against their W-2. You just need to make sure that if you're the real estate professional, all the real estate is in your name.
Great. And would a property management company be placed in an LLC or an S corp? What ideally, what would you recommend?
Because a property management company is doing things, we would put that inside the S corp. And if the property management company is managing your own real estate, you would put your real estate inside the LLC, and then your management would be inside an S corp.
And this is just for everyone to know, we will have the AOA $1 million trade show, and I know that Robert Hall and Associates will be speaking at that event. So, and then you're going to have a booth there too. You'll be there all day long, and I
Yes,
think
we will.
Tony will probably be presenting. But yeah, look at the claps going up. So I hope you guys can make that event. Just to put a bug in your ear, that's going to be actually tax day. It's going to be April 15th, and hopefully you'll have your taxes done before that, right? Anyway, so just an aside there. Okay, next question I see. I don't see a hand. Would moving inherited properties held in a trust into an LLC be considered an ownership change, triggering a property tax reassessment in California? And maybe the bigger question is that a good idea? But yeah, if you could answer that for us.
So when you're moved, so an inherited property just in itself is going to trigger property tax adjustment because it went from the person that passed to now you. But the actual switch from a trust to an LLC. So let's say you inherited the property 20 years ago or 10 years ago, whatever, and it's been in the trust for a very long time, and now you're moving it to an LLC. As long
Mhm.
as the ownership stays the same, it's not going to trigger it. And so, like, if I have the
Great.
property myself and then I put it into my own LLC, it does not trigger. That is an exemption. Or you take it out of an LLC and it's just to yourself, but you need to keep it 100% the same. And so, if I own the property myself and now I want to move it into a LLC that my husband and I both own that LLC, that is going to trigger a reassessment because you're changing ownership. I'm now adding my husband
Mhm.
to that ownership, and that's not good. It needs to stay the exact same. If you own it 100%, now your LLC needs to be 100%.
Great, great. Hey, Clyde, go ahead and unmute yourself and share your question with us. Give Clyde a second here. Hey, Clyde, you got your hand? There we go. All right.
Okay. I'm just wondering if I decide to put my California properties in an LLC, am I able to then become a manager and charge management fees or deduct management fees for the LLC that I manage?
I mean, you would, but you're also gonna have income. So you're just kind of cycling your own money, because you're charging yourself and you're receiving yourself. So you would get the deduction for paying yourself, but you also have the income for paying yourself.
Well, I don't know. I'm trying to get that straight in my head. I'm the owner of the property, so I have the burden of the income either way,
Yeah, but
tax
you're
wise.
not getting a better deduction by charging yourself.
Oh,
Like,
okay.
like it's
So
you're just cycling.
expense it as a real estate professional. Is that kind of what you're saying there?
Yeah,
As opposed to creating a separate property management company and having the LLC separate and doing.
right. I have a property manager, but I'm still totally engaged in the properties. Anytime
So,
issues come up, it comes through me and I have to make decisions. And I'm just
right.
wondering, how do I get,
If you have a property management company or a property manager that's managing that property, you're not going to be able to use that to help you qualify for real estate professional because you have somebody managing said property. So you can't say that, oh, the management takes my time and all of that because
okay,
it's
okay.
literally passive because you have somebody actively managing it.
I see. So I can't
Great,
manage the manager. Okay.
Correct.
great,
Thank
great,
you.
great. Thank you, Clyde. And then go ahead and mute yourself again. Awesome. You got it. Okay. Okay, here we go. Next question. Lots of questions. Nicole, thank you so much. I do want to respect your time. It's around 11. Do you have to get going right now
I
or?
can answer the questions. I'm fine.
Okay, let's do it then.
No
And
problem.
they'll be doing it all day too at the trade show. Okay, if I let me see. If you own an investment property outright, is there any tax advantage to getting a mortgage on it?
No.
Okay.
The
Okay.
taxes, no. No. The only type of benefit I would say if you own an investment company out or if you own a property outright and you're thinking about getting a mortgage on it to increase it, you just need to make sure that the interest rate makes sense. That the interest rate and the expense of getting said mortgage will be less, those expenses will be less than the profit for whatever you're going to use that money is. And so you need to make it. But in terms of the tax world, you're not doing that for tax. There's no benefit there.
Yeah. All right. Brian, if I purchased a property in November of 2024, is it too late to complete a cross segregation on this property?
It's about when you put it in service. And so if you purchased the property 45 years ago, 10 years ago, whatever, and it was a second home, you did not rent it out, that's totally fine. If you put it in service in 2025, you rented it out in 2025, you can get a cost segregation study now, even though it's 2026, to apply for 2025. That's totally fine. If you're thinking about maybe I should have done that, you might look at amending if it was put in service in 2024. You could amend your 2024 taxes. I wouldn't go crazy and start amending like 2023 and 2022, but 2024, okay. You might consider amending.
So I hear there's kind of a sweet spot for using cost segregation. What would that be for
So
people
I
to?
tell people you're going to need at least $500,000 of usable depreciation, and so that you're looking at a $700,000 per purchase.
Great.
But otherwise it doesn't, there's just not enough. And that's also really, really dependent on your current tax rate. And so it's very specific to each person. That's why I say get a free estimate and talk to your accountant. Just don't talk to the cost seg people because they don't see your tax return. Get the free estimate and talk to your accountant.
Okay, so Jeff here, is an LLC of any benefit for one single family residence with gross income of 40K and owner has 1 million general insurance policy for personal liability, or is it not cost effective?
If you just have one rental, I don't know if you really need the LLC. It's a more think of the LLC as an insurance. And so if you have a single rental, I don't know if that's something you need to go ahead and do, especially if you're in California. Because remember, if you're in California, your LLC is going to cost you about $1,500 every year
Hmm.
just to have, even if you don't run anything through it.
All right, we have one more question here in the Zoom, and then we're gonna get to the YouTube questions. Regarding the real estate professional, my wife is a realtor and manages our rental properties as well. However, rental properties are in both of our names. Can she still receive RE professional status for tax purposes?
Yeah, because she's a realtor, so yeah.
Yeah, yeah, she's bona fide there.
The rentals beyond, like, forget the rentals. Like, her being the realtor will give her the status.
Right. So thank you guys that are on YouTube. Um, Dan here, what is considered doing real estate? What tasks or jobs is considered that?
It's very, very open. Anything related to real estate, looking for properties, taking classes like these, it is all counted as part of your hours.
Okay. And Kevin, for professional real estate designation, do you have to be a licensed real estate agent or broker? Or if you are an investor developer, will it count as the same?
Yes, if you are active. active, right? And so if you're an investor, you don't have to have a license at all, and you have management companies for all of your real estate, no, because you're not active and involved in that. If you're doing trading and flipping and like all of that, that's fine too, but you need to have ownership inside this.
Great. And I know people are going to start to maybe hop off, and again, please look at the mid-month newsletter that we send out tomorrow, but specifically the way that the United States Postal Service postmarks things has changed as of December 24th. So if you're serving notices through the mail, the date of the postmark is not going to match what you have on your notices. And so anyway, there's going to be information about that, but basically I think there's a certificate of mailing, not to be confused with certified mail, where if you do that, you'll have proof of the day that you mailed it. And I just want to put that out there because there's already so many landmines. I just am fearful that that one may blindside you as you're trying to serve a notice. Anyway, we'll keep going on the questions here. Okay, could you please elaborate on the state and gift tax exemption changes?
It just the lifetime exemption just increased. And so it's just like up to 15 million.
Okay, up to 15. Okay, Alex on YouTube. Can cost segregation be included after 3 years of operation for short-term rentals? Yeah, what about short-term rentals?
Well, it's all about when we put it into service. And so because it's already been in service for 3 years, it's a cost seg is not going to be ideal. But you can do a cost seg on almost any large thing. It could be for short-term rentals, it could be commercial, it could be multifamily, it could be single family, it can be long-term, it can, that doesn't matter, but it's just about when you put it into service so that you can qualify for the bonus depreciation, because I can't take bonus depreciation on something that has already been used.
Okay, and someone's asking for the phone number for Robert Hall and Associates, and it's across. I know you're watching on Zoom. In the YouTube, it is across the screen. And let me see, what is it? It's
I can
818
give it, yeah.
47, I'm sorry, 452-2641. That's 818 452-2641. And anyway, so I know if you're watching on Zoom, it's a little bit harder to see all that.
No, our phone number is 818-242-4888.
Okay. Guys, if you can hear that, maybe you can update that little banner that's on the that banner on the bottom there. That would be great. And let's see here. Can all my rental property loans interest be deducted as expenses?
Can your rental property loans interest? Yeah,
Yeah,
of course.
great. All right, and let's
Any
see.
expenses you have with the rental, the
Right, we
taxes,
got to get all
of it.
those. Okay,
Yeah.
so Nicole, put it again one more time. I'll say it. 818-242-4888.
Yes.
You got the eights there. Okay, very cool. And then here's Ariel. So can you get the real estate professional status for tax purposes if you have 2 4-unit properties and you manage them yourself, but are not a realtor, probably is what they're going to say.
Yeah, it's not so you have to meet the three factors, right? For the real estate professional, you need to have the majority of your earned income come from it, the majority of your working time come from real estate, and then also you need to meet the material participation. The material participation, it's so easy to meet. That nobody needs to worry about that. That one's super easy. It's the other two. Do you have the majority of your earned income coming from real estate, and then also the majority of your working time? If both of those are yes, then yeah.
And one person had asked, is this being recorded? And absolutely it is. If you're watching from AOAUSA.com or if you're just here in on the Zoom meeting, AOA does have a YouTube channel and it's being broadcast there. It's being broadcast on X. as well, and Facebook. But yeah, if you go to YouTube and just type in AOA USA, our channel will pop up, and this will be the first thing that you see just because it's the most recent. And so you can go back and re-listen to things and yeah, just yeah, have it for reference. But Nicole, thank you so much. You have parting thoughts for us here?
I would just remind people there's a lot that you can do with your tax return. You just need to see what fits best with you, because not everybody is going to do everything, and you want to be comfortable and you have control. That is the beauty of it all. You actually do have control. We don't live in a flat tax state.
Great. Yeah, thank you so much. And guys, please give her a call again if you have other questions. And yeah, we're really thankful. Yeah, there's thank yous going up there for you.
Welcome.
Definitely. Thank you so much. And again, like your firm, 80% of their clients is roughly about 80% are rental property owners. Is that right?
Yeah, we as accountants believe in real estate, and so it just seeps into our clients, and it's just because it's just one of the best assets you could ever have. Like it just is.
Yeah. And
And
so you have rental property too?
I do 64.
Great, great, great. Okay, great. Well, hopefully we'll see you at the trade show, and hopefully we'll see some of you at the AOA Political Action Committee luncheon with District Attorney Nathan Hockman on Saturday, the 24th. Anyway, take care, everyone. Bye-bye.
Bye.
Thanks again.